Barclays halting new issuance of its exchange-traded notes tied to oil and volatility. Bob Bassani is here now with what he thinks is driving the move and what it means for those holding the products. Bob?
It's a little complicated, Kelly. One of these ETNs is tied to the CBOE volatility index, or the VIX, as we talk about it all the time. The symbol is VXX. And another one is tied to an index of crude oil futures. The symbol is OIL, oil. That makes sense. Barclays said it ran out of, quote, issuance capacity and that it would halt creations indefinitely. Now, it's not clear exactly what that means, but it's likely the risk was getting too high for Barclays. So an exchange-traded note is a debt instrument. It's issued by a bank. In the case of the VXX, the ETN tracks an index with exposure to futures contracts on the CBOE volatility index. In this case, it's a blend of the front month and the second month futures contracts. But here's the rub. Barclays may or may not own all the underlying futures. It may own derivative contracts. It may own nothing. It is likely certainly trying to hedge its positions. It only promises it will deliver the value of the index adjusted on a daily basis. While they don't say exactly why they did this, it's certain for sure the VIX did shoot up to over 35 in recent days on the Ukraine crisis. It's likely a lot of traders tried to short the fund, since the VIX rarely stays above 30 for any length of time. Now, this may have led to additional risk for Barclays because we don't know what they're doing to hedge their risk. You see the problem here. So what happens to the funds? Well, they continue to trade. But because there's no new shares, it is essentially acting like a closed-end fund. And like a closed-end fund, it may trade at a premium or a discount to its net asset value. In this case, it seems like it's trading at a premium. You know, Kelly, this is a big problem with exchange-traded notes in general. We've had problems with them for years. They're not transparent. It takes the best features of exchange-traded funds, which is transparency. You know what you own when you have an exchange-traded fund. And in this case, exchange-traded note, it removes it. You don't know what exactly you're owning at the same time. What you get is a promise, and it's easy for the bank to suddenly, or any bank to suddenly, suspend creations. It's been controversial for many, many years, Kelly.
Yeah, as you put it earlier, they are 2% of the volume of exchange-traded products and 98% of the problems, all these ETNs and leveraged and inverse ETFs. Let me ask you this, Bob. Could these products exist as ETFs? Or because of their sort of inherent obligations, would they not get a sponsor who was willing to do so?
No, sure. You can have there are ETFs that exist that own straight futures contracts, and there are a number of them that do. For whatever reason, banks issue these because they feel they can be profitable. Again, the key point here is that these are essentially notes that are issued by the banks. They may or may not necessarily own all the underlying products, and in some cases, they may certainly be trying to hedge them. So this is the problem, trying to figure it out. Obviously, Barclays felt they had some kind of risk here. It may be associated with the risk that they were taking when they were trying to hedge their positions against these futures contracts. We don't know. They're not telling us, so it would be helpful if we knew. But it's a problem with the way the product is structured. It's not a problem with the VIX or a problem with Barclays. It's just the way that the exchange-traded note product itself is structured.